Ever wonder why you might get paid, or have to pay, just for holding a crypto position? It sounds odd, but it's all about perpetual futures contracts. Unlike regular futures, these contracts never expire. You can hold them as long as you want, but to keep their price close to the real crypto price, the spot price, there's a special mechanism: funding rates. These aren't fees for the exchange, they're payments between traders. If you're long and the market's bullish, you might pay shorts. If the market's bearish, shorts might pay you. It's like rent or a bonus for your position depending on market conditions. This system keeps the perpetual futures market stable and fair. For traders, funding rates can eat into profits or boost returns, so ignoring them is risky. Understanding funding rates is essential for anyone trading crypto futures. They can make or break your strategy. Don't treat them as an afterthought. They're a must-know for smarter trading, especially with perpetuals. So, what exactly are funding rates? They're regular payments, usually every 8 hours between longs and shorts. Their job: keep the futures price close to the spot price. If the contract price rises above spot, longs pay shorts. If it drops below, shorts pay longs. This nudges prices back in line, like a magnet pulling metal. The exchange just facilitates. It doesn't profit from these payments. Funding rates are calculated using interest rates and the gap between futures and spot prices. The bigger the gap, the bigger the funding rate. This system incentivizes traders to act, restoring balance. It's clever financial engineering. Without funding rates, perpetual futures could drift far from reality. For traders, knowing when and how these rates change is crucial. They're not random. They're the market's way of self-correcting. Always keep an eye on them. Market sentiment drives funding rates. If everyone's bullish and piling into longs, futures trade above spot. So longs pay shorts. It's like too many people on one side of a boat. Funding rates help restore balance. This makes being long a bit more expensive and being short more attractive. If sentiment flips and everyone's bearish, futures drop below spot. Now shorts pay longs. This encourages buying and discourages excessive shorting. Funding rates act as a referee, keeping the market fair. It's a constant tug-of-war between bulls and bears. The direction and size of funding payments reveal the market's mood. Smart traders watch these signals closely. They can spot shifts in sentiment before prices move. Funding rates aren't just numbers. They're clues to what traders are thinking. Use them to your advantage. How do funding rates affect your trading? For active traders, especially with leverage, they're a big deal. High funding rates can eat into profits or add to losses, so always factor them in. Some traders use funding rate arbitrage, buying spot and shorting futures to collect payments. It's a precise, low-risk strategy if done right. For example, if the funding rate is 0.01% every 8 hours, a $10,000 long pays $1 each interval to shorts. With bigger positions or higher rates, costs add up fast. The main benefit: funding rates keep futures prices stable and close to spot. The downside: they can be a hidden cost or a surprise profit if you're not paying attention. Savvy traders use them for arbitrage opportunities. The key: always check the current funding rate before trading. It's essential for smart, prepared trading. Funding rates can make or break your strategy. Don't ignore them, use them to your advantage.